Welcome to Spidell's Federal Tax Minute. I'm your host, Catherine Zidane, and this week we're covering superseding returns and some things to keep in mind when you're filing these returns. But first, get all the news you need to keep your clients current, as well as new tax planning strategies to minimize taxes throughout the year with a subscription to Spidell's quarterly federal tax update webinar. You can register for the series or for a single session at spidell.com under the Webinars tab. The IRS has added a superseding return checkbox to the 1040 so that superseding 1040 forms can now be filed electronically. Previously, only superseding business tax returns like Forms 1120, 1120S, 1120F, 1065, and 1041 could be filed electronically. Superseding individual returns up until now had to be paper filed. A superseding tax return replaces a previously filed original return and is treated as the original return, and it incorporates new or corrected information. The superseding return is filed after the original return, but has to be filed within the filing period, including extensions. Common reasons for filing a superseding return include avoiding penalties, like the accuracy-related penalty, taking advantage of retroactive laws, changing filing status from married filing joint to married filing separate, allowing taxpayers to change how an overpayment should be applied, for example, changing an overpayment from being applied to the following tax year to requesting a refund, and for partnerships, avoiding having to file an administrative adjustment request. Under the centralized partnership audit regime, most partnerships no longer can file an amended partnership return. By automatically filing an extension request, partnerships avoid having to file an administrative adjustment request if they file a superseding return when they uncover errors or oversights within the extension period. The IRS doesn't allow an irrevocable election to be made on a return that's filed after the original due date, but on or before the extended due date. In these situations, the IRS doesn't treat the return filed after the original due date as a superseding return. Only a superseding return filed before the original due date can change an irrevocable election. Examples of common irrevocable elections include the IRC Section 179 election, filing married filing separate, or electing to apply overpayments to estimated tax payments in the following year. The date a taxpayer files an original return, not the later date of any superseding return, starts the running of the statute of limitations period. The IRS is required to assess additional tax for a given tax year within 3 years after the return for that year was filed. Or, if a taxpayer is filing a claim for refund, the taxpayer has to file the claim within 3 years from the time the return was filed or 2 years from the time the tax was paid, whichever period expires later. If both the original and superseding returns are filed before the original due date, this has no effect on when the statute of limitations begins because a return filed before the last day prescribed for filing is deemed filed on the last day of the filing period, and the statute begins on the original due date for the return. But a return filed on extension is treated as filed on the day it's received. So where the first return is filed before the last date prescribed for filing, the original or extended date, and a superseding return is filed during the extension period, the statute begins to run on the date the first original return was filed. We covered this topic in Spidell's Federal Tax Letter. For more details about a subscription to this monthly publication written by tax professionals for tax professionals, go to spidell.com and click Publications. That's all for this week. Join us next time for another episode of Spidell's Federal Tax Minute.